RBI's monetary policy.
Based on an assessment of the macroeconomic situation and its outlook, the MPC decided by a majority of 4 members out of 6 to increase the policy repo rate by 25 basis points to 6.5% with immediate effect. Consequently, the standing deposit facility, that is SDF rate, will stand revised to 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate to 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Let me now explain the MPC's rationale for these decisions on the policy rate and the stance. The global economic outlook does not look as grim now as it did a few months ago. Growth prospects in major economies have improved, while inflation is on a descent, though inflation still remains well above the target in major economies. The situation remains fluid and uncertain. Reflecting this recent optimism, the IMF has revised upwards the global growth estimates for 2022 and 2023. As price pressures wane, several central banks have opted for slower rate hikes or pauses. The US dollar has retreated sharply from its highest level in 2 decades. Tighter financial conditions caused by aggressive monetary policy actions, volatile financial markets, debt distress, protracted geopolitical tensions, and fragmentation continue to impart high uncertainty to the outlook for the global economy. Amidst these volatile global developments, the Indian economy remains resilient. Real GDP growth is estimated at 7% in 2022-23, according to the first advance estimate of the National Statistical Office, that is the NSO. Higher rabi acreage, sustained urban demand, improving rural demand, robust credit expansion, gains in consumer and business optimism, and the government's enhanced thrust on capital expenditure and infrastructure in the recently presented Union Budget 23-24 should support economic activity in the coming year. Weak external demand and the uncertain global environment, however, would be a drag on the domestic growth prospects. Consumer price inflation in India moved below the upper tolerance level during November and December 2022, driven by a strong decline in prices of vegetables. Core inflation, however, remains sticky. Looking ahead, while inflation is expected to moderate in 2023-24, it is likely to rule above the 4% target. The outlook is clouded by continuing uncertainties from geopolitical tensions, global financial market volatility, rising non-oil commodity prices, and volatile crude oil prices. At the same time, economic activity in India is expected to hold up well. The rate hikes since May 2022 are still working their way through the system. On balance, the MPC was of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, break the persistence of core inflation, and thereby strengthen the medium-term growth prospects. Accordingly, the MPC decided to raise policy repo rate by 25 basis points to 6.5%. The MPC will continue to maintain strong vigil on the evolving inflation outlook so as to ensure that it remains within the tolerance band and progressively aligns with the target. Inflation is expected to average 5.6% in the fourth quarter of 23-24, while the policy repo rate is, after today's revision, now stands at 6.5%. Adjusted for inflation, the policy rate still trails its pre-pandemic levels. Liquidity remains in surplus, with an average daily absorption of 1.6 lakh crore under the LAF in January 23. The overall monetary conditions therefore remain accommodative, and hence the MPC decided to remain focused on withdrawal of accommodation. I would now like to provide our assessment of growth and inflation. First, I would like to take up growth. Available data for Q3 and Q4 of the current financial year, that is 22-23, indicate that economic activity in India remains resilient. Urban consumption demand has been firming up, driven by sustained recovery in discretionary spending, especially on services such as travel, tourism, and hospitality. Passenger vehicle sales and domestic air passenger traffic posted robust year-on-year growth. Domestic air passenger traffic crossed pre-pandemic levels for the first time in December 2022. Rural demand continues to show signs of improvement as tractor sales and two-wheeler sales expanded in December. Several high-frequency indicators also point towards strengthening of activity. I have listed out some of the high-frequency indicators which show improvement and strengthening of activity in the footnote of my statement. As you know, the statement will be uploaded in the RBI website. So if you are interested, you may like to have a look at it. Investment activity continues to gain traction. Non-food bank credit expanded by 16.7% as on January 27, 2023. The total flow of resources to the commercial sector has increased by rupees 20.8 lakh crore during 22-23 so far, as against 12.5 lakh crore rupees a year ago. Indicators of fixed investment, that is cement output, steel consumption, and production and import of capital goods registered robust growth in November and December. In several sectors such as cement, steel, mining and chemicals, there are signs that additional capacity is being created in the private sector. According to the RBI survey, seasonally adjusted capacity utilization increased to 74.5% in Q2 22-23. The drag from the net external demand, on the other hand, continued as merchandise exports contracted in Q3 22-23. On the supply side, agricultural activity remains strong with good rabi sowing, higher reservoir levels, good soil moisture, favorable winter temperature, and comfortable availability of fertilizers. PMI manufacturing and PMI services remained in expansion at 55.4 and 57.2 respectively in January 23. Turning to the outlook, the expected higher rabi output has improved the prospects of agriculture and rural demand. The sustained rebound in contact-intensive sectors should support urban consumption. Broad-based credit growth, improved capacity utilization, government's thrust on capital expenditure and infrastructure in the union budget recently presented should bolster investment activity. Let me repeat, broad-based credit growth, improving capacity utilization, government's thrust on capital spending and infrastructure should bolster investment activity. According to our surveys, manufacturing, services and infrastructure sector firms are optimistic about the business outlook. On the other hand, protracted geopolitical tensions, tightening global financial conditions, and slowing external demand may continue as downside risks to domestic output. Taking all these factors into consideration, the real GDP growth for 2023-24 is projected at 6.4%. I repeat, the real GDP growth for 2023-24, that's for the next financial year, is projected at 6.4%, with Q1 at 7.8%, Q2 at 6.2%, Q3 at 6% and Q4 at 5.8%. The risks are evenly balanced. I would now like to turn to inflation. Headline CPI inflation moderated by 105 basis points during November-December 2022 from its level of 6.8% in October 22. So October 22 it was 6.8%, and by end December, I mean going by the December data, there was a moderation of 105 basis points, and that was quite a significant moderation. This was due to a softening in food inflation on the back of sharp deflation in vegetable prices, which more than offset the inflationary pressures from cereals, protein-based food items, and spices. As a result of this earlier than anticipated steeper seasonal decline in vegetable prices, inflation for Q3 22-23 has turned out to be lower than our projections. Core inflation, that is CPI excluding food and fuel, however, remained elevated. Going ahead, the food inflation outlook will benefit from a likely bumper Rabi harvest led by wheat and oilseeds. Mandi arrivals and Kharif paddy procurement have been robust, resulting in improvement in buffer stocks of rice. All these developments augur favorably for the food inflation outlook in 2023-24. Considerable uncertainties remain on the likely trajectory of global commodity prices, including price of crude oil. Commodity prices may remain firm with the easing of COVID-19 related restrictions in some parts of the world. The ongoing pass-through of input costs, especially in services, could keep core inflation at elevated levels. The commitment to fiscal consolidation that has been carried forward in the Union Budget 23-24 and the future trajectory of reducing the gross fiscal deficit will engender an environment of macroeconomic stability. This augurs well for the inflation outlook. Further, the low volatility of the Indian rupee relative to the peer currencies limits the impact of imported price pressures and other global spillovers. Taking into account these factors and assuming an average crude oil price Indian basket at $95 per barrel, inflation is projected at 6.5% for the current financial year, that is 2022-23, with Q4 at 5.7%. On the assumption of a normal monsoon, CPI inflation, now I am giving the projection for the next year. On the assumption of a normal monsoon, CPI inflation is projected at 5.3% for 2023-24, with Q1 at 5%, Q2 at 5.4%, Q3 at 5.4%, and Q4 at 5.6%. The risks are evenly balanced. Headline inflation has moderated with negative momentum in November and December. But the stickiness of core or underlying inflation is a matter of concern. We need to see a decisive moderation in inflation. We have to remain unwavering in our commitment to bring down CPI headline inflation. Thus, monetary policy has to be tailored to ensuring a durable disinflation process. A rate hike of 25 basis points is therefore considered as appropriate at the current juncture. The reduction in the size of the rate hike provides the opportunity to evaluate the effects of the actions taken so far on the inflation outlook and on the economy at large. It also provides elbow room to weigh all incoming data and forecasts to determine appropriate actions and policy stance going forward. Monetary policy will continue to be agile and alert to the moving parts of the inflation trajectory to effectively address the challenges to the economy. I now turn to the liquidity and financial market conditions. As we approach the end of 2022-23, it is worthwhile to recapitulate the key developments on the monetary policy front over the last 1 year. After the onset of the war in Europe, which drastically altered the global inflation dynamics, the global growth inflation dynamics across the world, including India, we have taken a series of steps in the best interest of the Indian economy. We accorded primacy to price stability over growth in April 2022. We instituted a major reform in monetary policy operating procedure through the introduction of the Standing Deposit Facility, that is SDF. We restored the width of the policy corridor to its pre-pandemic level. We raised the repo rate by 40 basis points and the cash reserve ratio by 50 basis points in an off-cycle meeting in May 2022. We shifted the policy stance to focus on withdrawal of accommodation. We continued the rate tightening cycle in every meeting of the MPC thereafter. And we adopted a nimble and flexible approach to liquidity management by conducting both variable rate reverse repo and variable rate repo operations as per requirement. As a result of all these measures, and this is very important, as a result of all these measures, the real policy rate has been nudged into positive territory. The banking system has moved out of the Chakravyuh of excess liquidity. Inflation has shown signs of moderation and is moderating, and economic growth continues to be resilient. As I make this statement, system liquidity remains in surplus, though of a lower order compared to April 2022. In the period ahead, while higher government expenditure and anticipated return of forex inflows are likely to augment systemic liquidity, it would get modulated by the scheduled redemption of the LTRO and TLTRO funds during February to April 2023. Under TLTRO and LTRO, as you would recall, during the COVID times, we had injected a lot of liquidity for periods ranging between 1 year to 3 years. And the last bit of that is coming back into RBI during February to April. The Reserve Bank will remain flexible and responsive towards meeting the productive requirements of the economy. We will conduct operations on either side of the LAF depending on the evolving liquidity conditions. As part of our gradual move towards normalizing liquidity and market operations, it has now been decided to restore market hours for the government securities market to the pre-pandemic timing of 9 a.m. to 5 p.m. Moreover, as part of our ongoing endeavor to further develop the government securities market, we propose to permit lending and borrowing of G-Secs. This will provide investors with an avenue to deploy their idle securities, enhance portfolio returns, and facilitate wider participation. This measure will also add depth and liquidity to the G-Sec market, aid efficient price discovery, and work towards a smooth completion of the market borrowing program of the center and the states. The